Hello everyone! In this video, we will discuss one of the most profitable trading strategies with a high win rate, the imbalance formation. Today, you'll learn how major market players leave clear traces on charts that are invisible to many beginners and how to work with these clues correctly to open high-profit trades. Additionally, we'll show a step-by-step action algorithm and break down setups that work for any market, whether it's cryptocurrency, stocks, currencies, or even commodities. After all, the price of oil and Bitcoin might move differently, but the logic of price formation is the same. Real-life examples will prove that this strategy works. If you're just starting to explore the world of crypto, or are already an experienced trader wanting to gain more insights in the right environment, we recommend checking out our Telegram channel. There, you'll find not only the hottest news and promising investment projects, but also top-tier analytics from experienced traders who share their trades in a free trading chat. So don't hesitate, click the link in the description and join us. Let's break down the basic concept. What is imbalance? Simply put, it's a gap zone on the chart that appears between the wicks of 3 consecutive candles. The color of the candles doesn't matter here. In a bullish or upward scenario, the upper wick of the first candle doesn't reach the lower wick of the third. There's an empty space between them, indicating a sudden gap in the market. In practice, this means that buyers suddenly became so active that sellers couldn't react in time. As a result, the price literally skyrocketed, leaving a gap between the wicks of the first and third candles. This zone on the chart is a place where either no trades were conducted at all, or their volumes were so small that they simply get lost in the overall picture. The main reason for such price imbalances lies in the actions of major players, like banks and investment funds. They enter the market with such large orders that the market can't adequately respond to this activity. This results in a sharp price jump, reflecting the market's attempt to handle the sudden influx of large volume. These zones on the chart become strategically important for further analysis because prices tend to return to these areas to restore balance and offer a fairer value for both buyers and sellers. In simple terms, the market seeks to correct itself. When you look at a chart, one of the first steps should be to identify imbalance zones. They literally reflect the movements of big capital. And where big money is, that's where you need to be. Because following the actions of institutional players significantly increases the chances of successful trades. To avoid confusion in the future, let's quickly go over the basic terms related to imbalance. They are often abbreviated as FVG, which stands for fair value gap. Sometimes these zones are also referred to as price inefficiencies. In contrast, effective pricing looks different. There are no gaps between the candle wicks on the chart, and the price is evenly distributed, offering fair value to both buyers and sellers. Despite the different names, all these terms describe the same situation, a gap on the chart caused by an imbalance between supply and demand. Let's explore what imbalance means from a pricing perspective. Firstly, it acts as a magnet for price. The market typically tends to return to these areas to restore equilibrium. Secondly, imbalance serves as a strong support zone. When the price reaches these levels, a noticeable reaction is expected, after which the market will likely continue moving in the direction of the current trend. For traders, these zones become excellent opportunities to open positions. Now, let's look at a chart on a smaller time frame. Here, you can identify another imbalance within a larger one. This pattern is common. Price inefficiencies manifest on both larger and smaller timeframes. Finding intersections of these zones allows for more accurate predictions of the level where a price reaction will occur. If you repeat all the steps, you'll see that the inner imbalance again acts as a magnet for price and as a support zone for opening positions. This zone was marked this way because the range between the swing levels below the imbalance has a higher priority for price movement. As you know, higher timeframes have a greater impact on the market than lower ones, and this rule is confirmed here. Consider the following situation, where an interesting detail can be observed. Starting from the upper candle, there are active sales from large market participants. The selling pressure intensifies so much that it significantly exceeds demand. This clearly confirms the formation of an imbalance, which can be marked on the chart from the minimum of the previous candle to the maximum of the next one. Its appearance is an early and strong signal of the beginning of a downtrend. The market generally seeks to restore the disturbed balance before continuing its downward movement, leading to a drop into the area of the lower imbalance. After rebalancing this zone, the upward trend gains strength again. Now, let's see how a bearish imbalance scenario develops. We observe a sharp price drop into the zone of hourly and 15-minute imbalance. At this stage, the price pauses slightly, filling the gaps, that is, processing previously unfilled orders. After this, the upward trend resumes its movement. The examples you see demonstrate the universal laws of price movement applicable across all markets, whether cryptocurrencies, stocks, or commodities. Mastering this concept allows you to predict major price movements in the future with a high degree of probability. Let's now break down how to accurately find imbalance within another imbalance. A time frame grid can be useful here, which can be adapted to the specific market situation. For example, to clarify a monthly imbalance, it makes the most sense to use weekly and daily timeframes. Delving into even smaller intervals doesn't make sense in such cases, as it can significantly reduce analysis effectiveness. The same principle applies to other frames according to the table. Let's consider an example, clarifying a monthly imbalance on a daily time frame. This approach not only narrows down the potential area of interest, but also increases forecast accuracy. You minimize risks and increase the likelihood of successful trades. This method allows focusing solely on key levels where a price reaction is most likely to occur, preventing you from chasing reversal points on the chart. Similarly, apply the same logic to other frames. Switch to smaller time frames to clarify areas of interest, then use the obtained data for detailed analysis and decision-making. Let's discuss how to select the most suitable imbalance for trading. On a chart, you might often see a situation where two bearish imbalances form during a price drop. At first glance, they might seem equally significant, but the right choice depends on their context within the market. To evaluate the potential of each, refer to the concepts of premium and discount zones. How do you do this? Draw a Fibonacci retracement from the peak where the decline began to the low where the correction formed. The 0.5 level in this retracement represents the balance line, indicating the fair value of the asset. Everything above this level is in the premium zone, an area where the asset's price is overvalued, while below is the discount zone, where the asset is trading at a discount. In the premium zone, major players like funds and banks aim to sell off their assets at the best possible price before further price declines. Therefore, the second imbalance, located above the 0.5 level, typically has greater potential for response. It is supported by the actions of major market players, and is more likely to result in a price reaction than the first, located in the discount zone. Remember that the market always seeks equilibrium, returning to the 0.5 level where supply and demand balance out. Ignoring the zones in the discount market not only reduces your risks, but also increases overall trading efficiency by enhancing the risk-reward ratio. This approach allows focusing on more promising trades that yield consistent results with higher profits over the long term. In a long scenario, the approach remains similar, but here we are solely interested in buying opportunities. The best entry points are in the discount market zone, where assets trade below their fair value. Any imbalance encountered along the correction path in the premium market zone should be skipped, as the likelihood of successful execution is very low. If an imbalance covers both zones, premium and discount, it becomes much more interesting. Such situations are fairly common. The optimal strategy here is to work only with the part located below the 0.5 level, making it our first zone of interest for opening a long position. If the imbalance is deep in the discount market zone, it becomes our backup entry point if the price doesn't reverse from the first zone. This approach helps minimize risks and significantly increases the likelihood of a successful trade. On the chart, you can see how the price sequentially tests the marked zones, bouncing off key levels and forming an uptrend. This process vividly demonstrates how well-defined zones of interest can aid in accurately predicting future market movements. In summary, regarding premium and discount zones, it is important to highlight that this approach falls under conservative strategies. However, it's worth noting that sometimes this method may lead to missed opportunities, especially when prices move too aggressively and do not return to the fair value level during corrections. Nevertheless, despite this drawback, this approach provides more stable and predictable results over the long term. If your goal is stability rather than chasing every price movement, this strategy will be a reliable ally. Now let's move on to the next important step, where we will create a simple and effective trading setup based on the imbalance formation. In the presented table we discussed earlier, you can see successful combinations of timeframes suitable for analyzing almost any chart. For example, when you start with the daily timeframe, this is where you should conduct the main work. Here, the overall market direction, key liquidity pools, and unfilled imbalance zones are determined. After this, you move to a lower timeframe, in this case, the hourly one. Here, the task is to refine the daily imbalance, look for reversal formations, and enter the trade. This sequential and structured plan allows finding frequent and high probability setups based on the logic of market movements and the actions of major players. In the future, we'll break down each of these steps in more detail. You'll learn what factors to consider before opening a trade, how to choose entry points based on price imbalance, and how to place stop losses and take profits effectively. The first and arguably most important step is determining the market direction on a higher time frame. This involves analyzing the market structure, taking into account unfilled imbalance zones and unswept liquidity pools. Let's consider an example of an uptrend consisting of 5 candles. Key elements to focus on are the last higher high and higher low, forming a trading range that sets the boundaries within which the price is currently correcting. It's interesting to observe a situation where there's a downtrend within an uptrend, a phenomenon you'll encounter regularly. Such movements are often initiated by major players to bring more liquidity into the market. Above each high, buy orders accumulate, and below each low, which is swept during the correction, sell orders concentrate. These orders are used by large institutions for opening long positions and subsequently increasing the asset's value. Support from major market participants indicates the trend's strength and relevance. Therefore, the next important step is identifying the end of the corrective cycle and targets for further growth. Next, highlight key price levels. In our example, these are equal highs and lows, artificially created to attract less informed traders' money. This capital is then used by smart money to achieve their goals. It's important to understand that from a smart money perspective, these levels are not support and resistance in technical analysis, but zones of critical liquidity concentration that will inevitably be breached. Liquidity is the driving force of any market movement. The market moves cyclically, shifting from one liquidity zone to another, creating patterns observable across all markets and timeframes. To better understand this dynamic, you need to study the concept of internal and external liquidity. This will give you a clear understanding of how and why the price moves. Understanding these processes is key to stable and profitable trading. Consider a classic uptrend. Its key elements denote areas of external liquidity accumulation, while internal liquidity includes all swings between the current higher low and higher high. The mechanics of an uptrend development are quite simple. First, external liquidity associated with purchases is swept, forming a new high. This event reduces the available funds in the market and creates a need for asset redistribution in the opposite direction. During the correction, the market accomplishes 2 main tasks. It sweeps internal sell liquidity pools and eliminates previous price inefficiencies. These actions encourage traders to open new positions, filling the market with the liquidity necessary for major participants to continue the initial movement. The cycle ends with a price move toward a new external liquidity zone, after which the process repeats. This is a continuous dynamic based on changes in market liquidity volume. It's crucial to remember that after sweeping external liquidity, the price tends to move toward internal liquidity and vice versa. This is a cyclical process that can be predicted. Based on this, we can expect price movements toward internal liquidity pools, further reversal, and asset growth toward external liquidity zones. To refine these forecasts, we add a third step to the analysis: identifying available imbalances, which will become zones of interest for opening positions. The first imbalance is in the discount zone and includes key factors enhancing its significance. Above it are internal sell liquidity pools, providing major participants an excellent opportunity for active purchasing at favorable prices before the trend continues. The second imbalance is bearish, formed within the current price range. Its appearance signals the intention of institutions to lower the price further, which can be used for short-term short positions. The primary goal is to return to the first imbalance. The third is located above the external buy liquidity zone. This is the FTA, or first trouble area, on the path of upward movement, where a price reaction can be expected. It will likely lead to at least a correction, during which internal sell liquidity pools will be swept. Thus, just a few steps allow constructing a high-probability price movement plan to work with in the coming days. Consequently, we await the rebalancing of the bearish imbalance and consider opening short positions. Inside a bullish imbalance, look for a reversal to open long positions. Expect the last high to be updated and the price to reach the area of the third price imbalance, which is our key target, from where we can consider short positions again. Next, we'll move to a smaller time frame to see what actions to take in the zones of interest to increase the likelihood of success. Transitioning to a smaller time frame plays a crucial role and allows you to achieve three important objectives: refine the zone of interest identified on the higher time frame, confirm the reversal, and most importantly, find the optimal entry point for the trade. On the example of a 15-minute time frame, the first step is to refine the previously marked imbalance zones. This helps to significantly narrow down areas of interest where we anticipate a price reaction. After this, you can adjust the trading plan made on the higher time frame. For example, for a local short position, we'll target the minute imbalance zone, where a reversal is highly likely and the price may begin to decline. The target in this case will be the start of the 15-minute bullish imbalance, which might serve as a reversal zone upwards. To confirm a reversal, focus on three main factors. First, the removal of buy liquidity. Second, a sharp price decline accompanied by a structure break. Third, the formation of a new bearish imbalance, signaling the start of a downward movement. Even if the structure break doesn't occur, the bearish imbalance itself is a sufficient early reversal signal. In this case, place a limit order to enter short at the start of the zone of interest. Set a conservative stop loss above the last high and a take profit at the start of the 15-minute bullish imbalance. Partial profit taking can be done upon removing internal sell liquidity. This approach provides a risk-to-reward ratio of 1:6, which is excellent. As practice shows, the price often moves perfectly between institutional zones of interest and trades conclude within a few hours. Additionally, you can consider two approaches to opening long positions: aggressive and conservative. In the first case, set a limit order at the start of the 15-minute imbalance and a stop loss below the second candle's low on the 4-hour time frame. Targets will be the nearest previous high and the start of the bearish imbalance. Here, we act based on analysis without waiting for reversal confirmation. In a conservative approach, wait for a local structure break and look for a long entry point on the correction. For example, after a reversal and the start of a correction, the main target becomes the support zone in the discount market. On the 5-minute time frame, refining zones provides additional precision. Often, within an order block, a small price inefficiency is visible, whose achievement signals a reversal and the potential for a long entry. Each order block on smaller timeframes must include zones of interest, as these provoke price reactions. Successful testing of an order block includes the removal of sell liquidity, a structure break in the opposite direction, and the formation of a new zone of interest from which to consider entering a position. Place a limit order to buy at the start of the imbalance. For the stop loss, you can choose between two options: below the nearest low, which is more aggressive, or behind the last swing where the setup loses relevance, which is more conservative. Targets are set at levels marked on the higher time frame or locally, for example, at the last high where the correction began. Thus, setups based on sequential analysis of higher and lower timeframes demonstrate high precision and effectiveness. These simple yet effective steps will help you find profitable trading solutions. You've learned the theory, but if something wasn't clear, feel free to rewatch that section and write to us in the comments. We're here to help you figure everything out. Also, remember that any strategy should be tested first before trading with real money. This allows you to hone your skills, boost your confidence, and improve your trading results. And finally, if you want to stay at the forefront and not miss the best opportunities, our Telegram channel is your ticket to the crypto elite. Think about it. Top-notch analytics, hot news, trades from pros, and all for free. While others are guessing where the market is heading, you'll already be one step ahead, armed with knowledge and strategies. Let's be honest, who else will explain complex things in simple terms besides us? So stop putting it off, click the link in the description and become part of our crypto family. After all, it's better to be in the flow than to drown in a sea of uncertainty. See you in the chat, and that's it from us for now. Until the next video, bye.